So I think the way the market's evolved, so we all know that the number of IPOs has decreased fairly substantially from the peak, 10, 15 years ago when there were 400 a year. Now there's kind of 100 a year in terms of tech IPOs. So the void has been filled essentially by later stage private capital, which has filled the void very nicely, but people still need liquidity. I think there's a great desire to go back and increase the outlet for the public markets, not the least of which is so that the American public can participate in some of the growth of these fantastic companies. But what's happened in our world is that growth now, if you look at growth equity, on the one hand, you have late stage VCs who will invest in companies that fit exactly the description that I just gave you at the beginning of the panel. So it's hard to differentiate, but they're just late stage VCs and they're doing a similar kind of model. You have mid-market buyout funds who also will follow a similar sort of model. And then you also, on the other side, if you look at the averages, I think over the last couple of years, it used to be the average deal size for growth equity was kind of 45 million, and now it's more like 62 million, according to PitchBook, something like that. So the average deal size, the average pre-money valuation has gone up, and the average deal size has gone up.